All right, let's cut right through the noise today. We are moving way past the vanity funding announcements and those flashy top-line growth metrics that everyone loves to talk about. Instead, we're looking squarely at the invisible digital infrastructure of African startups. We're talking about the unglamorous foundational systems that actually determine whether a company scales, survives, or completely collapses in emerging markets.
Welcome to the Upside Journal Explainer. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet, a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, countercyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing.
Here is how we're breaking this down for you today. First, we'll cover the VC paradox of 2026. Second, asymmetric information and verification. Third, the multi-layer architecture edge. And we'll wrap it up with the repeatable flywheel framework. Okay, let's dive right into Act 1, the VC paradox of 2026, and look at exactly why so many legacy models crashed. Back in the early 2020s, a massive paradox really plagued venture funding models. We literally saw millions pour into full-stack B2B e-commerce platforms trying to digitize retail. But if you look at the survivors versus the casualties, a clear pattern emerges. On one side, you have the vanity metrics trap. This is where companies got crushed under heavy fixed costs in physical logistics, owning trucks, managing 20-plus warehouses, all while chasing razor-thin 3 to 6% wholesale margins. Then the capital dried up. On the other side, you have the true invisible systems. These are asset-light, API-first models that embedded finance directly into their transactions, successfully keeping their non-performing loans below 0.5%. The ultimate proof of this thesis is omni-retail. Rather than buying fleets of trucks, they built a highly efficient transaction engine. In 2024 alone, their fintech arm processed over 1.3 trillion Nigerian naira. To put that into perspective, that's roughly $810 million in transaction volume. And they use that massive volume to disperse high-margin, buy-now-pay-later inventory credit. That staggering $810 million figure proves that embedded finance is the real high-margin engine that outlasts a macro downturn. Moving on to Act 2, asymmetric information and talent verification. This is where operational friction really kicks in. Now, you simply cannot build these massive transaction engines without a foundation of institutional trust. Take a look at this startling data point from the 2026 Smile ID Digital Identity Fraud Report. Fraud isn't just random anymore. It's highly industrialized and networked. In a single month, just 100 real faces were reused across more than 160,000 fraudulent verification attempts. Think about that scale for a second. Attackers are actively using generative AI and network clusters to just hammer high-value financial targets until the system eventually breaks. Because of that, the entire defensive paradigm has had to change. Traditional visual proof, where a system just asks if a selfie matches an ID in a simple pass-or-fail test, is completely obsolete now. Bad actors manipulate that easily using virtual cameras and emulators. So, the new operational baseline revolves entirely around system signals. Modern startups now have to verify if the captured data and the actual device environment itself can be trusted, mainly by analyzing network patterns over time. The solution to this operational friction is what we call trusted capture. This means securing the inputs at the very source using device integrity, camera provenance, and metadata to expose repeat assets. And this isn't just a theoretical concept. MasterCard recently took a strategic minority investment in Smile ID specifically to scale this kind of advanced identity verification across the continent. By combining MasterCard's global payments network with Smile ID's data provenance tech, they are building the exact infrastructure needed to securely onboard the next 300 million African users, entirely bypassing those legacy bureaucratic bottlenecks. That brings us perfectly to Act 3, the multi-layer architecture edge. Let's look at how these systems stack up. Once you establish that trusted identity, you can start stacking interoperable modular systems. It really requires 3 distinct layers operating in unison. First, you have your identity APIs for secure digital onboarding. Think Smile ID or the FIDA ID in Ethiopia. Second, you need interoperable payments for instant, low-cost routing, driven by rails like MasterCard and FastT. And finally, automated compliance, utilizing robust data pipelines like G2PEX to handle all the cross-border KYC and AML requirements. This multi-layer architecture is absolutely crucial because it enables precise targeting and incredibly affordable connections at massive scale. And the scale of the opportunity unlocked by this architecture is just immense. In Nigeria alone, there are 74 million adult citizens who are either unbanked or underserved. Traditional brick-and-mortar banks simply cannot reach that demographic profitably, but through these invisible systems of embedded finance layered on top of open banking protocols, this massive population is finally positioned to access the credit and savings they need to grow. Let's map out how we actually got here. All of this is built on top of open banking, which has seen a really rapid regulatory evolution. We went from the initial frameworks in Kenya and Nigeria back in 2021, to Nigeria finalizing operational guidelines in 2023, then Kenya publishing draft rules in 2024, leading all the way up to the phased go-live and compliance rollouts we're seeing today in 2026. The plumbing of a truly data-driven financial ecosystem is officially coming online right now. Finally, Act 4, the repeatable flywheel framework. Let's walk through the actual operator playbook.
So, knowing this infrastructure exists is one thing, but how do successful founders actually leverage it? Here is the exact four-step operator's playbook they use to build durable enterprises. Step 1, audit your internal dependencies. Basically, stop trying to build everything yourself. Step 2, integrate API-first infrastructure. Step 3, partner with specialized providers. If you need logistics, tap into third-party networks. If you need identity verification, plug into an API. And Step 4, use the data you accumulate to scale institutional trust across cross-border corridors. When you execute that specific playbook in a B2B context, you unlock 3 highly lucrative product categories that completely replace the need for massive capital expenditures. You can offer buy now, pay later inventory credit, you can command embedded payment processing and orchestration, and you can provide working capital term loans against the receivables on your very own platform. And because of your data visibility, you aren't taking blind risk. You're reducing operational friction and bringing underwriting risk well below what a traditional bank could ever achieve. And this brilliantly illustrates our core economic insight for this explainer. Whether you're looking at Omni Retail or the Wasoko Maxeb entity, the lesson is identical. The messy, physical distribution business that simply exists to fund the funnel. It drives the volume and creates that invaluable proprietary data layer. But it's the fintech business, the embedded credit and the payment rails that actually funds the company and generates the hidden alpha we've been talking about. But as investment strategists, it's our job to look at the horizon. These models have performed beautifully in benign conditions, but a sharp macroeconomic downturn is going to stress test this API-first underwriting to its absolute limits. Startups are going to have to prove that their sub-0.5% non-performing loan ratios can actually withstand real market pressure. The operators who can navigate these crosscurrents are the ones who are going to define the next decade of growth in these markets. Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. We'll leave you with this to ponder. As open banking compliance fully takes hold this year, how will it shape the next phase of institutional trust? See you in the next explainer.